Welcome to my economics channel, where I love discussing the subject, but most importantly, I love to make something fun and interesting to learn. And to that end, I want to discuss how the money multiplier theory for money creation and how banks work is not only incorrect, it's comically, farcically incorrect. And despite the fact that it seems so intuitive and so appealing, and the fact that it seems like it couldn't possibly be incorrect, that's in fact what it is. It is flat out wrong, even though the theory is still taught in some economics textbooks today. I have previously made a video on this topic, especially where I lampooned Graham Stephan and his take on the money multiplier theory, but that video itself wasn't very good and shouldn't be watched by anyone. And that video is going to get deleted as soon as this one starts to get a bit more traction. This time I've got three much better sources that I'm going to be drawing upon for this video. And the reason I chose Graham Stephan as an example for this is that he's a very big finance channel, if not one of the biggest. However, he has fallen off in recent months. So I think it's still worth putting him in. So firstly, we're going to go to what he has to say about the money multiplier theory, and then we're going to get into the video.
As Cascades Academy pointed out, both the US and China employ a system called fractional reserve banking, where a bank is only required to keep 10% of their customers' assets on hand at all times. The rest could be freely lent out or loaned to other institutions for a profit. Just imagine it like this. You give me $1,000 to hold on to for safekeeping, but I'm allowed to turn around to give $900 of that to someone else who gives $810 to someone else who gives $709 to someone else, and so on. Or in other words, they're betting that no more than 10% of their customers are going to want all of their money back at the exact same time. But since 2019, China's been lowering these reserve requirements to allow for more money to be spent, which would temporarily prevent the economy from slowing down.
And so given what Graham Stephan just said, the theory is very appealing. We sort of have a bank in the middle, or the banking sector, and our money comes in on this side, and then that can get multiplied out. Let's say $100 comes in, $110 worth of loans can be made, and that's sort of $10 that's sort of unbacked, if you will. It almost seems like leverage. It's sort of like money that's sort of created out of thin air. And it also plays into our biases we have in general around banks and the banking sector, especially to do with 2007 and 2008, where a lot of the blame was put on the banking system. Now, whether or not the criticisms against the banking sector back then are fair or not, they still play into how we think about the banking sector, and more importantly, how we think about how it works. Now, the best way to think about how the bank lending process actually works is to imagine that we have two separate systems of money. And these systems run in parallel and they interact with each other, but they are separate systems. So, on the one hand, we have the central bank on this side, we have the banking system here, and then we have reserves in the middle. There are many different names that we have for reserves, but the best way to think about it is that it's simply reserves. And a good reason for that is that in the US, the central bank is called the Federal Reserve System. It refers to the money that is used between the central bank and the banking system. Now, on the other hand, we still have the banking system here, and we have everyone else here. We have you and I. Now, there are many different terms that we can use to describe the money that you and I use on a day-to-day basis for all of our transactions. But the simplest way is to simply call it credit. This is credit that's created by the banking system. The banking system creates roughly 97% of the quote-unquote money that you and I use. And it comes from the reserve system over here, and it's translated into credit or bank money that you and I use. So on the one hand, we have reserves over here. That's its own system. However, that influences and is influenced by the credit creation out here. And this is where people get the idea that we sort of have a money debt contract, in that every money, there is an asset and there is a liability. If you're using money as an asset, someone else has it as a liability. Most of the time, that liability lies within the banking system. When banks create new credit, when they extend new loans, they are creating an asset and a liability. And following on from what I've just said, in post-editing, I thought it would be good to add the following from one of my sources. And we get, quote, "Money itself then has a dual character, representing both a credit-debt relationship between the creator of the credit, i.e. the bank, and the original recipient, the debtor, and simply money that can then circulate within the economy. Thus, for Huber, 2016, we get the following quote. There is no such thing as, quote, debt money or, quote, credit money. What really exists are credit and debt relationships on the one hand, and money, just money, on the other hand, once a deposit has been entered into a bank account and starts circulating. It keeps circulating irrespective of the creditor bank and debtor customer that were the origin of the respective amount of bank money. And this is what I've been calling credit for this video. Only as the debtor pays back an according amount of money, principal plus interest, to the creditor bank is that amount of bank money deleted. And so an individual bank, when it makes a loan, doesn't necessarily have to have 100% of the reserves beforehand, before making the loan. It can make the loan based on the criteria from the borrower first, and then look for the reserves later. So if it's making a $50,000 loan, for example, and it only has $25,000 of reserves at the time of making the loan, the bank can find $25,000 of reserves later. And the point here being that when that loan is created, that is new credit that can be used in the economy. That is credit that didn't exist in the economy before. And so that is the growth of what we call the M3 money supply, or simply M3 credit growth. And this indeed would seem to vindicate the money multiplier theory, where banks don't need to have all of the reserves on hand in order to sort of multiply up those reserves out into the economy. However, it's worth pointing out that this is true of a single bank. One bank can do this, but not every single bank in the banking system. So for example, this bank that needs to find, let's say, $25,000 of reserves can only do so either from another bank in the banking system or from the central bank. Borrowing from the central bank is necessarily more expensive than borrowing from another bank in the banking system. So if there's a certain amount of reserves out here in this parallel system, this amount of reserves must satisfy every single bank at the end of the day. So for example, that bank that has to find $25,000 of reserves must come from another bank that didn't make a $25,000 loan, for example. However, it could also be that by the end of the day, that bank gets $25,000 of deposits, customer deposits transferred down to that bank. And therefore, it doesn't actually need to find additional reserves at the end of the day. But the thing is, those deposits came from another bank. If those deposits came from another bank, that means that other bank could not have extended a loan itself. So what that means is that whilst an individual bank can create loans and can indeed create more credit than it currently has in reserves, like for example, it can create a $50,000 loan even though it might have $0 worth of reserves or additional reserves at that point. However, by the end of the day, it must find $50,000 worth of reserves. And actually, this is where we get our market rate of interest from, the overnight interest rate. We get it from this interbank market. A bank that borrows from another bank and a bank that lends to another bank, they lend to each other at the same interbank or the same overnight rate of interest. However, if it turns out that this bank cannot find $25,000 worth of reserves at the end of the day, for whatever reason, it can borrow from the central bank. However, there's going to be a price. Let's say the interest rate is 1%. It might be that the central bank charges 2% in order to borrow from it. It might also be that there's a surplus bank out there and it has $25,000 worth of reserves, but it doesn't want to lend to the bank that needs to borrow those reserves. That bank can lend to the central bank, but in keeping with our example, let's say the market rate of interest is 1%. We then have the rate at which banks can borrow from the central bank at 2%. It might be that the rate at which you can lend to the central bank be 0.25%. And this is in fact where we get our corridor system from. We have a lower bound, which the central bank controls, and we have an upper bound, which the central bank controls. And this is why the market rate of interest is almost always in between those two rates. It is better for both banks to do a deal with each other than it is to separately go to the central bank. And inevitably, those two banks, they're going to trade at a rate that's in between those two rates that the central bank controls, and this becomes the market rate of interest. And this is how credit out here and the reserve system here, how they interact with one another. And so as I mentioned, a single bank can indeed make a loan out here first and create new credit that you and I use as additional purchasing power that didn't exist before, and that bank can then find the reserves later. However, the only reason that bank can do that it can feel confident that it can do that in the first place, is because any central bank controls the amount of reserves in the system. And given the rate of interest that the central bank wants to maintain, it controls the amount of reserves. Sometimes it might need more reserves, sometimes it might need to suck up reserves from the system. And so there's always a mixture of surplus and deficit banks. There's always going to be activity in the banking system because the central bank ensures that it has the right amount of reserves given the rate of interest. However, it could indeed be the case that there are persistent surplus banks and they're constantly borrowing from the central bank at a higher rate of interest. In this case, it might be time to raise interest rates and raise the cost for banks, which will then cause them to lend less into the economy and then cause less credit creation out here for the rest of us. However, the opposite could also be the case, and it might be that the central bank needs to lower its interest rates and therefore encourage more banks to lend out into the economy because their own borrowing costs are lower. And so when thinking about the lending process and about money in general, that's why I was saying it's better and indeed more correct to think about the two forms that money takes. On the one hand, we have reserves out here, which is what the central bank uses with the banking system, and this is a system that you and I don't have access to. However, this influences and is influenced by credit out here. And credit is what you and I use on a day-to-day basis. And so this idea that there's simply the banking system and then sort of money sort of comes in to the banking system and then it's sort of multiplied out, and there's sort of a requirement to keep a certain amount of reserves, is not only incorrect, but it's farcically so. And it also doesn't consider the difference between the lending done by one bank versus the lending done by the banking system as a whole, and the consequences for that, and especially how the central bank has its own administered rates and how this influences, or some might say controls, the market rate of interest. And indeed how this then leads into credit creation out here and the money that you and I use on a day-to-day basis. And so that's the end of the video. I hope that was useful to you. If you have any questions, don't hesitate to ask down below and I'll do my best to answer, or at the very least I'll collect the questions and answer them in a follow-up video. If you wouldn't mind subscribing and sharing my videos, that would be amazing, so I can reach a wider audience and eventually make money from my channel, which I guess in a third-hand sense will also make you feel good about yourself as well. But thank you for watching all the way to the end, and I hope to see you guys in the next video.